And the government can't print gold, and the government can't print Bitcoin. The government can't print silver. Government can't print real estate either. Real estate's got some issues with taxation and so forth. So my number one investment choice is Bitcoin, but gold is quite closely right behind it. So that's kind of where I'm at. Assets are Bitcoin and gold. And since 2020, the price of Bitcoin is up 2,000% compared to the sovereign bonds, the long-term sovereign bonds. And the price of gold is up 250% compared to the price of sovereign bonds. So what that tells you is that the markets are saying, hey, we don't trust these governments not to keep printing a lot of money and debasing the value of these bonds. Oh, and by the way, we do think these other assets, gold and Bitcoin, which can't be printed, we think they're more attractive compared to bonds. I mean, Bitcoin's going to multiple millions of dollars per coin.
Lawrence Lepard issues a direct and pressing warning at the beginning of his commentary. The current financial system is headed in an unsustainable direction. He highlights a serious disparity between the real economy and the debt's unrelenting growth. History tells us that there are only a few possible outcomes when governments and central banks accumulate debt faster than economies can produce real goods and services, Lepard said. A significant devaluation of the currency, uncontrollably high inflation, a decline in confidence, or a complete overhaul of the monetary system are some examples. Frequently, a combination of these things occurs instead of just one of them. If you're intrigued by bold predictions and deep financial insights, make sure to like this video, subscribe to the channel, and turn on notifications for more engaging content. Thank you for your support and enjoy the video.
And so my big theme is that, the mathematics of the situation suggest that we've got too much debt. The debt claims are much larger than the underlying goods and services. And that typically, historically, leads to either some kind of a monetary reset, some kind of a collapse, like, the 29 and 30 depression, or, it's seriously high inflation, or some combination of all three of those. Very hard to know exactly what's going to happen because we really don't know what the government's going to do, what the policy moves are going to do. But what we do know is that if you grow the rate of debt in excess of the rate of GDP, eventually you run into a problem because you have to suddenly print more money in order to be able to pay the interest on the existing debt. And we really are in one of those situations where, all of the monetary rules are changing. And so the average investor or average person trying to figure out where to put their money, what to do with it, how to protect themselves, in the next 5, 10, 15 years. And the government can't print gold, and the government can't print Bitcoin. The government can't print silver. Government can't print real estate either. Real estate's got some issues with taxation and so forth. So my number one investment choice is Bitcoin, but gold is quite closely right behind it. So that's kind of where I'm at. I think that people who don't have, call it 20% or 30% of their investable savings or assets in things that represent, tangible sound money, I think they're going to experience regret in a 10-year time frame. And by that, the things I would put in that bucket would be houses, because you can't print them. Silver and gold, because you can't print them, and Bitcoin, because you can't print them. Stocks, I would put they're kind of in the middle. It depends on which ones, it depends on what timing, it depends on valuations. The stock market's pretty overvalued right now. But in general, stocks always reprice in whatever the new currency is. So even if we go through a currency event, stocks may go down for a while, but if they're sound companies doing sound things, they'll reprice and be good places to have capital. So gold, silver, Bitcoin, and the dollar, they're all legal tender, and we let them compete with each other. There's no capital gains tax on any of those. I mean, you don't pay a capital gain on a dollar. A dollar's just a dollar. If gold goes up in dollar values, there should be no tax on that because these are all forms of money. So I'd start there. Then I would say we should eliminate the Federal Reserve, just literally shut it down. If we want the dollar to survive, we should either back it by gold or back it by Bitcoin or some combination of the two. And, that would make the dollar sound. If not, I think the dollar would go away in a freely competitive system. And that really kind of represents a reset where, the government might come out and say, okay, well, we aren't going to, if the Fed's gone, so they can't print money, we aren't going to create any more dollars. The number that exists is what exists. And we're going to back the dollar with gold or back the dollar with Bitcoin, and the government stands willing to exchange the dollar for those two assets. And so they would all find their natural price against one another. I mean, Bitcoin's going to multiple millions of dollars per coin. There's never really been a financial asset like this because it's a commodity. I mean, one's the same as the next. It's a limited supply commodity that's never existed before. And if you think about how other commodities behave, if the price of oil goes up, we'll drill for more oil. The price of gold goes up, we'll mine more gold. Price of Bitcoin goes up, doesn't matter. Same supply.
Fixed. Yeah.
We just saw, and it came back in quite a bit recently because the Japanese obviously intervened, but we just saw the Japanese long bond, the JGB 40-year go up. The rate on that went up really substantially, very quickly. We saw it in Britain in 2022 when Liz Truss said she was going to increase expenses and cut taxes, and their bond market went up and she had to reverse her policies. We saw it in the U.S. in the fall of 23 when our rates went up over 5%, and the Fed immediately came out with 10 people saying, no, we're not going to keep raising rates. We've seen it just in terms of the two biggest assets. The clues that this is going on, Julie, in my opinion, are watch the assets that are anti-bubble, and those assets are Bitcoin and gold. And since 2020, the price of Bitcoin is up 2,000% compared to the sovereign bonds, the long-term sovereign bonds, and the price of gold is up 250% compared to the price of sovereign bonds. So what that tells you is that the markets are saying, hey, we don't trust these governments not to keep printing a lot of money and debasing the value of these bonds. Oh, and by the way, we do think these other assets, gold and Bitcoin, which can't be printed, we think they're more attractive compared to bonds. That's what the market is saying loud and clear. And my sense is this is just the beginning of a trend. There's some people who say, well, gold's run awfully far, or Bitcoin's run awfully far. It's got to be a bubble. It's going to come back in. And I say, no, au contraire. We're actually just getting started.
Historically, when monetary systems broke down or were dishonest, civilizations fell. For instance, by cutting coins and using less silver, Roman emperors devalued their money. Eventually, the usage of paper money in ancient China caused severe inflation. Because they are so easily manipulated, government-controlled fiat currencies have repeatedly failed. Lawrence Lepard points out that even the Bible emphasizes the importance of fairness in money. It praises honest weights and measures, while condemning false and deceptive ones. Just like inches or liters, money should be a reliable and consistent way to measure value, not something that changes based on political decisions. For further updates on Bitcoin and the wider world of digital assets, please take a moment to like this video, subscribe to the channel, and enable post notifications before we go any further. Thanks, and enjoy the video.
Yeah, you're talking about the debt doom loop where new debt is incurred to service the old debt. Yeah. Are we already there in that loop? Or we
really are. I mean, if you look at the math, I mean, we're...
explain the math for us. That's interesting.
Sure. I mean, well, first of all, when Powell took interest rates up, the federal debt, the interest on the federal debt went up substantially. It was in the 400 range. It went up to, it's running at like 1.2 trillion annualized. That happened, and that's a problem. Inflation went up a lot, and the bond market sold off. And the doom loop, as briefly described, is that the federal government runs a deficit. How do they pay for the deficit? They borrow money to pay for the deficit. That increases the amount of debt outstanding in the system. So somebody has to buy that debt, and the person buying that debt says, what interest rate are you going to give me for it? And if there's a fixed amount of people willing to buy it and the amount of the debt goes up, well, then the interest rate by its very nature, supply and demand, it's going to have to go up too, because some people say, well, I'm not going to buy it at 3%. You got to pay me 4 or 5 or 6% to buy it. Well, that's fine. So let's say interest rates go up to 5 or 6%. And as they did, they went up to 5% in the fall of 23, and the Fed panicked. That's when they talked about they were going to keep raising rates. And so when interest rates go up like that, it creates a bigger burden for the federal government, because the federal government's got $37 trillion of debt. And, this year alone, 7 to 9 trillion, depends on which estimate you believe, are going to roll over. So higher interest rates, that rolls over. Well, then they got to pay more on the debt. Well, that paying more means that deficit gets bigger. That means they got to sell more debt. You see what I'm talking about here? It's like a vicious circle.
That is the doom loop.
That's the doom loop. So, okay, hang on a sec. So you got to sell more debt. Well, you sell that debt in the market. Well, that means you're going to push the interest rate up. Higher interest rate. That means you're going to have a bigger deficit. That means you got to sell more debt. So that's the doom loop, and that's kind of the bigger picture of what's going on. And I don't really know how to get out of it. I mean, without the currency collapsing. That's the problem. Money really plays two different roles. One, it's a savings vehicle. You hope to retain, value through time and space. So if you do some work and, you don't want to eat today, but you want to eat in the future, you save your money so you can do that. And then money also is a medium of exchange. You use it to buy things and trade for. And when you're using it as a medium of exchange, the inflation is not necessarily as important, because you might get money and spend money, and you don't really see much slippage between the time you receive it and the time you spend it. But as a store of value, it's very important. And over time, what happened historically in the world is that humankind, kind of naturally, not driven by governments, gravitated toward forms of money which couldn't be debased. And we tried a lot of different things. I mean, seashells, tobacco, I mean, you name it. But 5,000-6,000 years of recorded history, and gold and silver kind of became the de facto accepted best forms of sound money. And the reason is that they are geologically limited in their supply. The supply of gold grows at 1.7% a year. And so, for money to have value, it's got to be scarce. This is why monopoly money has no value, because, the Parker brothers can print an unlimited amount of it. And so, and in theory, when the U.S. was behaving responsibly, when we were on a gold standard and the dollar was backed by gold, well, the dollar was sound. But what slowly happened, as the book describes, is that we just kept knocking out the little, the supports underneath the dollar until eventually in '71, Nixon locked out the very last one. And now the dollar has no backing. I mean, it's backed by the faith and credit of the federal government, which, how good do you think that is, given all the deficits they're running in their balance sheet? But sound money was always money which was scarce, which could not be just, printed out of thin air. Fiat money, the experiment started hundreds of thousands of years ago. The Chinese tried it, others have tried it. Fiat money was always by definition money that governments by fiat said, this has value, and I declare that it has value, and you will accept it. And, if it was done responsibly, if a government said, well, gold and silver, will be money, and they'll be we'll make coins, and they will be made of gold and silver. So there's intrinsic monetary value there. Well, then the inflation might have been lower. Although, people tended over time, what they did was they clipped the coins, or they would dilute, like in Rome, they started off with silver coins. They ended up with iron coins, and so, there's been a trend all throughout humankind for, this goes back to the Bible, right? There's a chapter in the book called, sound money is a moral issue. And I really believe it is, because people in general, we're not all perfect, and people will try and cheat if they can. And, the authors of the Bible know this, because they talked about using honest weights and measures, and saying cheating in weights and measures is an abomination to God. And so, basically, money is a weight or a measure, and it ought to be sound in the sense that it shouldn't be variable. An inch doesn't vary, a foot doesn't vary, a gallon of water doesn't vary. We have measures of things, and yet we've got this elastic currency that is always continually kind of losing its value.
Lawrence Lepard delivers a powerful and deeply concerning explanation of what he calls the doom loop in the U.S. economy, a vicious cycle driven by rising interest rates, unsustainable debt, and the erosion of trust in fiat currency. Given that between $7 and $9 trillion in U.S. debt is expected to roll over this year alone, Lepard highlights the perilous nature of this cycle. The government will have to refinance at the higher prices if interest rates are higher when that debt matures, which will worsen the deficit. The United States will eventually be unable to borrow its way out without experiencing a significant financial reset or the currency falling. He then moves on to a more in-depth conversation. What exactly is money? According to Lepard, money serves as both a store of value and a medium of trade. It might not seem like much when you're only utilizing it to make fast purchases. However, when inflation gradually reduces your purchasing power, it becomes a significant issue if you're attempting to save money for the future. Similar to how a gallon must always have the same volume or a ruler must always measure 12 inches, sound currency must maintain its value throughout time. According to Lepard, when the dollar was backed by gold, the United States had a sound money system. However, the government gradually eliminated such subsidies until at last, President Nixon broke the ultimate link to gold in 1971. The U.S. government's full faith and credit is now the sole thing supporting the dollar. Lepard also doubts the strength of such faith and credit in light of the trillions of dollars in debt and the widening deficits. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.